I'm Alison from FX Scouts. In this video, I'm going to be talking about a topic that can be quite tricky for new traders to grasp. And I'm going to be talking about pending orders. I'm going to be talking about how they're used and why they're used and why they're different to market orders. But I'm also going to be showing you how you can use them in your various trading strategies. So what are pending orders? Well, they're basically a type of order that you direct your broker to open at a later time when certain conditions are met. Pending orders basically automate the trading process so that you do not have to sit behind your trading terminal all day in order to execute orders. And there are three types of orders. There are market orders, limit orders, and stop orders. So if we jump into market orders are the straightforward order. They are executed instantaneously. And these orders allow you to basically immediately buy or sell a currency pair at whatever price they're trading at that moment. Then if we look at limit orders, there are two different types of limit orders. You get a buy limit order. A buy limit order is an order that is placed below the current price in anticipation of a bullish trend. So essentially, you are buying whatever asset you're trading at a better price than the current price. For example, the CHF JPY is currently trading at 166.60. You believe it can reach as low as 165.94 and then it'll rise. And if you want to have an automatically triggered buy order at 165.94, you should use a buy limit pending order. Basically, a buy limit order lets you enter a trade at a better rate than currently available. Then if we look at sell limit orders, they're basically the direct opposite of a buy limit order. So they allow traders to sell an instrument at a higher price than the current price. They basically allow you to sell at a better price. For example, USD CHF is currently trading at 0.9016, and you believe that if the currency pair reaches 0.9520, it'll surely go down after that. If you want your broker to enter a short position at 0.9520, then you'll set a sell limit pending order. Like a buy limit order, a sell limit order lets you enter a trade at a more favorable rate than the current market offer. Next, you get stop orders. And again, there are two types of stop orders. So firstly, you get the buy stop. So buy stop is placed in the overall direction of the trade, and it is a pending order to buy a currency pair at a price that is higher than the current price. For example, the CHF JPY is currently trading at 1.6659, and you believe that if the currency pair goes up to 167, it will trigger an upward trend. For example, a major resistance level may be broken. If you want a long position at 167 automatically, you should use a buy stop pending order. With a buy stop order, you always enter at a price worse than you get when you set up the order. Then of course, you also get a sell stop, and like the buy stop, you get a worse price than the current price. And this is because you will sell at a lower price than you're currently getting. For example, gold is currently trading at $1,993.3. And you believe that if the pair declines to 1983, it will trigger a strong bearish movement, or a major support level will be broken. If you want a short position open automatically at 1983, you should use a sell stop pending order. And a sell stop pending order implies that you are ready to sell at a price worse than the current price. And lastly, other pending orders are stop losses and take profits. These are obviously tools for risk management. So a stop loss helps you to prevent excess loss on your trades, and it is basically triggered when a designated level has been reached. So it can only be set to the level above the price for short positions and to the level below the current price for long positions. It is basically a buy stop for your sell trades and a sell stop for your buy trades. Almost all Forex brokers offer stop losses and take profits, and we always suggest that traders use stop losses as part of their risk management strategy. If you want more information on these orders, please visit our YouTube channel, and I will place a link to that in the comment section. Take profits are basically used to close a position when you have made a satisfactory amount of profit. Similar to the stop loss, take profits also close a position once a certain level has been reached. And it can only be set to the level below the current price for short positions and to the level above the current price for long positions. It is basically a buy limit for your sell trades and a sell limit for your buy trades. So what are the pros and cons of pending orders? Well, there are many pros. Firstly, they prevent you from losing time, so you don't have to sit and wait for that price to be reached. Your trading terminal will automatically buy or sell a position based on your set parameters. Secondly, it prevents slippage. Many market orders are prone to slippage just because you cannot always get the price you hope for when you press sell or buy. But pending orders will only open once that exact price has been hit. The only con to using pending orders is that you may miss your trade. So if you have a buy limit set up at 1988.9 USD on gold and the trade continues up in bullish momentum, then you may miss the trade. Thanks so much for watching. If you have any questions, please send us a message. Our website is fxscouts.com, or alternatively, you can leave a comment in the comment section below. And please remember to subscribe and like.